When examining the world's most valuable assets, such as silver, gold, and Bitcoin, based on market capitalization, Nvidia, the world's leading AI company, now ranks as the fourth most valuable asset globally, with a valuation exceeding $2 trillion. In less than a year, Nvidia has doubled its market cap, and if this growth continues, is on track to surpass giants like Apple and Microsoft in value. This year, Nvidia's value soared by over 80% in just the first 3 months, and in the previous year, it delivered a staggering 262% return to its investors. To put this in perspective, achieving such returns through traditional stock market investments at a compound annual growth rate of 10% would take over 13 years. This impressive performance raises questions about the sustainability of such growth and whether we're approaching a market peak similar to those in 1997 or 2000. Some experts, like Jeremy Grantham, suggest we might be in a bubble, while others remain optimistic about the potential of AI technology. This situation has a bright side and a downside. On the one hand, those who bet on Nvidia for the wrong reasons still ended up making a fortune. On the other hand, if Nvidia's performance falters and doesn't meet expectations, its declining stock price could temporarily pull down the entire stock market. However, the prevailing sentiment is optimistic, with many believing Nvidia's value will continue to rise. Another question is just how much further Nvidia's value could climb. Right now, Nvidia's worth surpasses the GDP of many countries, getting close to Canada's GDP. If I were analyzing this as a stock picker, I'd look at the price-to-earnings ratio, which compares a company's stock price to its earnings per share. For tech companies on the Nasdaq, the average PE ratio historically hovers between 28 to 30. A lower PE ratio can indicate that a stock might be undervalued. Currently, Nvidia's forward PE ratio is over 37, signaling that investors are anticipating significant growth and the stock is priced at a premium. This doesn't rule out the possibility of further increases, but it implies greater risk if Nvidia doesn't meet the high growth expectations. This Wednesday, the FOMC is meeting to decide on interest rates, essentially determining the cost of borrowing money. Currently, there's a 98% chance that interest rates will remain the same at 5.5%. While the stock market prefers lower rates, which could boost tech stocks like Nvidia, it's unlikely rates will drop. An important saying for investors to remember is that markets can behave irrationally longer than you can afford to wait for them to correct. Even if you correctly identify a stock as overvalued or undervalued, it might not adjust to its true value as quickly as you'd expect. It's also possible that Nvidia might not be experiencing a bubble because the AI sector is highly profitable and Nvidia is earning significantly. This situation is somewhat reminiscent of 1997, when the internet was becoming a daily part of life, and investors were making bets on various companies, not knowing which would succeed. Many lost money on ventures like Pets.com, but this led to a realization. Investing in companies providing essential tools, like Nvidia, which makes GPUs for AI applications such as ChatGPT, could be more reliable. Just as miners during a gold rush needed shovels, AI developers need Nvidia's GPUs. However, with significant investments come greater risks. For example, OpenAI could start developing its own GPUs, potentially reducing Nvidia's market share. Despite these risks, Nvidia's stock could continue to outperform the S&P 500 because the market often remains detached from fundamental values. The next investment trend in this sector might involve identifying companies that produce the specialized tools required to make these foundational tools, essentially creating tools for the tools. This approach is significantly riskier because it involves focusing on smaller, less-known companies that larger ones might want to purchase or acquire. This could lead to a resurgence in interest in smaller-cap stocks, suggesting that the Russell 2000 index could be a speculative avenue for investing in this trend. If you enjoyed, click subscribe for more financial news and analysis.